It turns out when the entire tech world is panicking to build out infinite AI, the people selling the literal factory equipment to do it, they kind of just print money. Welcome to Earnings Unscripted. It is May 14th, 2026, and we are diving into Q2 for Applied Materials, ticker AMAT.
Yeah, look, last quarter, they were finally clearing out those old legal clouds. But this quarter, this is a pure structural gold rush. Top-line revenue came in at $7.91 billion, which is a new record, up almost 13% sequentially.
Which is just a staggering amount of hardware. And real quick, just as a reminder, since we throw these big numbers around, we are just two friends talking markets. So this is definitely not financial advice. Do your own digging. But Mira, 13% quarter over quarter for a heavy equipment maker, that is huge. Are they just shipping every single thing they can build?
Pretty much. I mean, customers are absolutely, well, panicking is the right word. They are panicking to secure spots in line. The top clients are handing them 8-quarter rolling forecasts, 2 full years of locked-in capacity planning. In the semi-equipment cycle, that level of forward visibility is practically unheard of.
Wait, 8 quarters? So chipmakers are basically booking their purchase spots deep into 2027 to make sure they do not lose the AI data center war.
Exactly. The shift to what management called Agentic AI requires vastly heavier logic and memory footprint. But the funny part is the headline profit number, because it looks like an absolute blowout, right? They reported a record GAAP EPS of $351, up 38% from Q1.
Okay, but you said it looks like a blowout, so I know you found the catch.
There's always a catch. The actual operational EPS, the non-GAAP number, was $286, which is still very strong, up 20% year over year. But that massive GAAP record, it was juiced by a $685 million unrealized gain on strategic investments. So it's a paper windfall. It's entirely below the line.
Right. Okay. So the core business is booming, but the headline profit got a huge assist from just holding the right equity assets. That actually explains the after-hours tape pretty well, because the stock went kind of crazy. It spiked up to around 472 right after the print, but then it just completely gave up the ghost and faded through the evening. It basically closed the extended session flat against the prior day.
Yeah, the market is exhausted by perfection right now. The stock ran up roughly 30% during the quarter. So, a paper investment gain is not going to trigger a brand new buying frenzy. Institutional money looks at the actual operations. And operationally, to be fair, they executed. GAAP gross margin actually ticked up to 49.9%.
It really is fascinating. The whole planet relies on these physical machines to build out this digital future. And I loved this little human detail from the call where the CEO mentioned they have 35,000 employees actively using AI internally now to speed up their own R&D. It's very much the shovel makers upgrading their own shovels.
It would be crazy not to at this point. It's a massive efficiency loop. But the real story here is not the employee tools. It's the underlying demand mix, specifically what's happening under the hood with advanced packaging and how that's fundamentally changing their segments.
Yeah, that feels like the real crux of this quarter. All right, let's get into the details on those segments.
Right. So for the longest time, packaging was essentially the most boring part of the industry. You bake the incredibly complex silicon wafer, and then you just sort of glue the chip into a little black plastic square.
Yeah, totally unglamorous. Just shipping material, basically.
Exactly. But we are hitting the physical limits of 2D space on a single chip now. You literally cannot make them any wider without severe defect rates. So to feed those massive agentic AI models they were talking about, foundries have to stack different chiplets together in 3D. And packaging is suddenly the biggest bottleneck.
So that explains why they bought that NEXX business. I saw that in the filings, and honestly, I almost glossed over it.
Oh, you cannot gloss over that. They are acquiring NEXX from ASMPT to go heavy into large area panel packaging because it is incredibly margin-rich right now. Gary Dickerson actually explicitly pointed this out. He said on the call, let me find it, right. We expect to grow our packaging revenues more than 50% in calendar 2026.
Wow!
50%. For an incumbent heavy machinery company is absurd.
It really is. Okay, but wait. If demand is that wild and they have these 8-quarter wait lists, it feels like a flawless victory. But
nobody scales 50% by magic. Where does a boom like that actually strain a company of this size?
Working capital. It always shows up in the cash flow statement first.
Because the cash has to leave before it comes back as revenue.
Precisely. If you are ramping production that aggressively, you have to buy all the parts, the raw materials, months ahead of time. Their non-GAAP free cash flow completely fell off a cliff this quarter.
Okay, I do not have the cash flow line handy. How bad of a drop are we talking?
Well, it was roughly $1 billion in Q1. In Q2, it was $210 million.
Down to 210. Wow. That is a massive haircut.
Massive. They took a $1.75 billion net drain just in operating assets and liabilities, so mostly inventory and receivables. They are fronting a huge amount of cash just to keep up with the panic booking from clients.
That makes sense. I mean, the foundries are panicking. They are throwing orders at Applied Materials, and then Applied has to basically trap all its own cash and inventory to physically build the chambers.
Right.
Which is actually pretty stressful. I mean, they are running a thermal budget at Redline, to borrow your phrasing.
I like that. But yeah, it shows the pure friction of hypergrowth. Now, I might be overstating the risk because they still have over $13 billion in cash and equivalents sitting around. They're not going bankrupt, but it is a very real control system feedback loop. You literally run out of working capital oxygen if you're not careful.
And if data center spending suddenly flatlines, they're sitting on billions of dollars of very expensive half-built metal.
Yes, they are entirely reliant on the AI momentum staying exactly where it is.
Which makes that new epicenter they're building in Sunnyvale make a lot more sense.
The Innovation Hub, yeah, where they're putting all the competitors in the same building.
Right. They're basically moving TSMC, Samsung, SK Hynix, literally all these fierce rivals into one collaborative lab to co-develop these processes, which seems crazy for a secretive industry.
It is smart, though. Co-locating R&D compresses the learning cycles. If you're developing the tools side by side with the end client, you essentially de-risk your own supply chain. You never build the wrong machine.
Exactly. You know exactly what the customer needs because they're literally down the hall. So, if we pull all this together, the massive demand visibility, the working capital crunch, and physically locking the customers inside their own lab, where does this actually leave them heading into the next few months?
With what is essentially a license to print money and, well, an uncomfortable amount of risk tied to one very specific narrative.
Which is the AI infrastructure boom just never ending, right?
Exactly. Look at their Q3 guide. They are pointing to roughly $8.95 billion in total revenue. That is another 13% sequential leap from the record they just set. Dickerson expects the semi-equipment business to grow more than 30% this calendar year alone.
Okay, so they are not just riding a wave. They are assuming the wave becomes an ocean. I mean, do they actually believe that?
They claim they do because of that unprecedented 8-quarter visibility. They are already calling 2027 another record year. But here is the actual blind spot: geopolitics.
Right, you cannot just build massive global tech hubs right now and pretend international trade is totally fine.
No, and an analyst explicitly brought up the Huawei situation on the call, asking about potential new export blocks, and Dickerson completely dodged it. Quote, "Relative to restrictions, I don't really want to comment on that." He just claimed everything is factored into their guide.
So basically, look at the shiny revenue growth and please ignore the political storm clouds.
Pretty much. You're betting that regulators leave this market alone and that the massive cash flow drain they are stomaching right now actually normalizes. But, to be fair, they are executing the demand in front of them flawlessly.
They really are. I mean, you can't argue with the hardware they're actually shipping. All right, I think we have analyzed the AI shovel makers enough for one day.
Agreed. Time to close the book on this one.
Thanks for hanging out with us and making sense of the noise, everyone. Catch you on the next one.
Take care.
So if you like having these earnings teardowns just automatically show up in your feed, go ahead and give the show a follow. And just a quick side for anyone new, this entire podcast, from the script right down to our voices, is actually generated by AI, which is still a little surreal to think about. We always want to know what you want to hear next, so just drop your ticker requests or any feedback to us at earningsunscripted.datamadness.ca.
Talk to you next time.